Performance webinar series, the next installment in this series of learning. Of course, my name is Erik, Janeczko. I'm head coach and CEO of Maximum Acceleration, the professionals coaching company. And this webinar series we launched back in October of 2012 with the desire to bring a community of folks together who were dedicated to improving and refining their ability to take a better, provide a better level of service, a higher caliber of service to their clients through an ongoing learning process. And the next installment in this series is today's concept or topic of decoding the myths and misconceptions of credit scoring, what you need to know about what is really stopping your loans from moving forward. You know, as we've been working professionally in coaching and training now for approaching our 10th anniversary, will be coming up here in October, as we've been working as a team for the last 10 years to help accelerate growth with mortgage professionals across the country, one of the challenges always becomes the complexity of underwriting guidelines and finding ways to get deals done. You know, we all know that, you know, we have buyers who, you know, we all experience challenges in the growth of our business, right? We all know we've got desperate buyers. They want to buy a house. That seems to be the only thing they're focused on, and they don't really care how. If they don't get the right kind of advice and support along the way, they can easily get discouraged. Sometimes they even start getting the process backwards. I mean, how many times have you had a realtor bring you a borrower to pre-approve who's already in contract and they have miserable credit issues and they're not going to qualify? And that realtor, I mean, how painful is it to share with that realtor that they've just spent 10, 15, 20, 30 hours working with a family, showing them property, and they're in no position to buy? And so, you know, to work against that trend, the topics and ideas that we're looking at today is helping recognize and understand how we can make a difference for those families who have some need to do some work in their credit area and improve scores. And you know, there's a number of factors that play into that our guest panelist is going to share with you or talk with you about in a little more depth today. But, you know, what it really comes down to is out of every 10 potential buyers we talk to, they're going to fall into one of 4 buckets, right? You know, 1 out of 10, 2 out of 10 maybe are ready to go right now. They've got everything together. They've got great credit. They've got their income and asset position in place, and they're ready to rock, right? The second bucket is the folks that are questionable. They may or may not go. They're right on the fence. They've got a couple of derogatories maybe 2, 3, 4 years ago. Their credit scores are marginal, and if anything were to change in their credit profile between the shopping and searching process and as they move towards closing, because they're so close to the edge of the fence, we got to be very careful to make sure that we work with that client to understand how to get them in through that lending process, because they are right on the bubble as to whether they're going to qualify or not. The third bucket is the bucket that, you know, they're not dead, they're not completely hopeless, they don't have 5 bankruptcies and you know, a bunch of collections afterwards. There's some hope, but they need to do some work. They need to reestablish some more positive credit to offset the negative credit that they accumulated through financial hardship or just being young and stupid earlier in their lives. And so, but that's one of the buckets where we can make some of the biggest difference, because, you know, if you think about the dynamic of it, my personal experience and many of our coaching clients have shared with me that, you know, out of every 10 buyers we talk to, 1 or 2 are ready to go right now, 1 or 2 are on the bubble, 4 or 5 could get ready in 6 months to 12 months with a little bit of work and effort and discipline, and 2 or 3 are probably hopeless. It's the 4 or 5 that have some hope and have some potential that could be a huge gold mine of opportunity. And so as we look at that opportunity, what can we do to educate and encourage those clients to work towards that path to homeownership, and what are the tools and resources that are going to help them do that? Well, today's guest speaker is Mr. James Charlet, who is the Chief Operating Officer of CRE Credit Services. He's recognized widely as one of the leading experts in the area of credit scoring. He is he sits on the board of NACSO, which is the National Association of Credit Service Organizations. He's a frequent panelist. His track record and experience, though, comes from the fact that he served as the elite legal team and compliance group for Experian, and as an executive frequently testified before government committees and has regular dialogue at the highest levels of the financial and regulatory industry with CFPB and the credit organizations, dealing with FACTA and some of the regulatory issues and concerns about how to manage credit. My personal experiences, guys, when I heard James speak the first time, I knew I had to get him on this series because I've been to 2 or 3 or 4 day workshops on credit scoring with experts and the PR people that Experian or TransUnion or the credit scoring bureaus send out to speak at MBA conferences or NAMB conferences. I never heard the level of detail and the accuracy of information that James shares in his programming. So at this point, James, I'm going to turn everything over to you, let you take us through what you've got to share with us today, because I know you've got just a wealth of information you want to present to our audience today.
Absolutely. And of course, I could talk about it for hours, but I don't have only 30 minutes today. So again, good morning, everybody. I want to get kind of right into the meat of it. Whenever I teach, the very first 2 things that I always want to focus on are risk and the gray area. They say from any type of presentation like this, within 6 months, you're going to only remember about 15% of what I said. Make sure these 2 things are in that 15%. So first of all, risk is the focus of the entire industry. Credit reporting, credit scoring, all of those jobs, all of that money, all of that information is there for just one purpose: to determine the risk that that potential borrower is not going to repay the debt to whoever lends it to them. That's it. It seems simple, but obviously it gets very, very complicated. But one thing that you can definitely say is, if it's something that doesn't involve risk, then it's not in the scoring model. And so I've got a few examples here that are very common. If you go and right now Google opt-in, opt-out, and scoring, you're going to see that there are supposed experts out there that tell you over and over again that simply opting out of receiving the pre-approved notices is going to improve your score. I've seen it anywhere from 5 to 30-point claims. Quite frankly, it's just completely false. Opting in, opting out was something that was created to try to prevent identity theft. It is a right that consumers have. They can go to a government website, optinoptout.org, and choose to not receive those pre-approved offers from Experian, Equifax, TransUnion, but it will have absolutely zero bearing on the credit score because it's just not predictive. It's not indicative of whether or not someone has the capacity or the ability or the willingness to repay their debt, and therefore it's not something that gets factored into a credit score. Another example is soft inquiries. Inquiries tend to fall in one of 3 buckets: hard, soft, and then there's kind of a gray area in between. Hard inquiries, the assumption is that your borrower went and applied for something. They wanted an extension of credit. Those types of inquiries can impact the score. But inquiries where they already had a relationship with a bank and they just checked their score to see where they're at, do they want to offer them more credit? That's a soft inquiry. It's an account review, AR inquiry. Promotional inquiries, like we're talking about with that you can opt out of, those don't impact the score at all. When the consumer checks their own report, those do not impact the score at all. In fact, all of those types of inquiries I just discussed would only be visible to the consumer on their consumer credit report that they got online or ordered through the mail. You would never see those on a mortgage enhanced credit report. Here's one that's a pretty common misconception: is statements of continued dispute. Now, when an account is actually under investigation, when the consumer has said, hey, I don't agree with what this is saying, and the credit reporting agency has asked the subscriber, whoever it might be, Citibank, Capital One, to respond to that request, during that time frame, that's usually 30 days or less, there is a code that goes on that does suppress certain parts of the account and can artificially raise the score during that 30-day time frame. But once that 30-day time frame is gone and that statement of continued dispute that the consumer can write themselves, or sometimes it's a canned statement such as, account was in dispute, now resolved, consumer disagrees, meets requirements of FCRA or FCBA. Those types of statements absolutely do not impact the credit score at all, positively or negatively. And that's a very common misconception out there. In fact, there's obviously, I think many of you probably know, even Fannie and Freddie sometimes get confused as to what the difference is between those dispute codes and which ones actually impact the score versus the ones that don't. Authorized user accounts is on the other side. There was a little bit of a push back in the 2007-2008 timeframe to start disregarding authorized user accounts because of a perception that they were perhaps being misapplied, or that it was inaccurately giving a picture of a consumer that they really didn't have. And there was an attempt to start to suppress those authorized user accounts. It did not work. Right now, authorized user accounts do get factored into the score just like any other trade line. Now, for certain overlays or for certain underwriting purposes, on the back end, they might say, oh, well, I'm not going to count those authorized user accounts towards the positive credit history of that individual for underwriting purposes, but nonetheless, the score that got them into underwriting to begin with was absolutely impacted by those authorized user accounts, okay? And I didn't say it when I started off here, but please, at any point in time, if you've got any questions, I love them. I love to answer them. So put them in the little question box over there, and we will do our best to get all of those answered for you, okay? All right, moving on to the next slide. Next slide. Next slide. Next slide. 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 What was that? Did everybody hear that just now? That was odd. Okay.
It was an echo effect. I took care of it, James. You're ready to go.
Oh, all right, cool. Thanks, man. All right. So the gray area, like I said, the two main things, we just talked about risk. The other main area, again, if you don't remember anything else from today, this is the other area. Because if you can understand that everything is geared towards risk and that there's gray area on virtually everything, it's going to make you understand a lot more and be able to siphon out some of the misinformation that gets, that gets out there, and especially on the web on a daily basis. So number one about this, everything affects everything else. And what I mean by that is within a credit scoring algorithm, there are lots of different pieces of it, and they all impact one another. So you might say that spending a little bit of extra money on a credit card and having that ratio increase, well, that's only going to cost me a few points there. But having that higher ratio, there are other scorable codes, other things that go into the scoring algorithm, like utilization, like a mix of credit history, like a volume of revolving debt, that can also be more heavily impacted by having that thing happen. So even though that one might only cost you 5 points, it might cost this other code over here that was costing you 2 to now cost you 6. So the net decrease in score is 9, even though that one particular item that happened was only 5, because it changes your risk pool. And that's why it makes it very difficult, and you can pretty much always assume incorrect for someone to say, oh yeah, this action is going to cost you this number of points. Well, without looking at the entire report and really understanding how the algorithm works, that's a very, very hard thing to say. Because you can have two people with identical credit scores, both at 720, and both commit the exact same action on the exact same day, and have it radically have different changes in their credit score. Just based on, again, why were they at a 720? Were they being suppressed to a 720? Were they right where they should have been? There's all these other things that come into play where it's very difficult to accurately predict what one action is going to do without knowing all of the information in that report. Okay. Another thing, and this one's a little bit more tricky for people to really wrap their heads around sometimes, but risk modelers, the statisticians that are creating these algorithms and trying to predict people's behavior based on their past financial behavior, they are consistently sampling the general population and tweaking the algorithm based on the data they receive. So for example, they might take a group of 10,000 people who had a late payment on an automobile account 6 months ago, pull them up today, and see, has there been a lot more of them that had a foreclosure? Has there been a lot more of them that went late on their mortgage? Has there been a lot more of them that went late on their credit cards? Has there been a lot more of them that got a new collection? And if the change on this sample is statistically significantly different than it was on the last sample, then they'll go in and change the scoring mechanism to reflect that predictability. And what that means for your borrower is, so let's say your borrower, Sally, had a late payment on her car 3 months ago. And today, she's a 640. And today, that study that I just described is conducted. Well, tomorrow, after they tweak the score, she's going to drop. Her score is going to go down, even though nothing changed on hers. Now, and I will say, even saying nothing changed is not true in itself. Things change every day, whether the consumer does anything or not. Time passes. Some things that go into the score have to do with just the passage of time. How long have their accounts been open? How long since their most recent account opened? Lots of different things. And so maybe today they're at 4 years, 12 months, and 30 days, and tomorrow they pass a threshold that their average account life is 5 years. By just that one day of passage, being that happens to be that threshold, their score would go up. But that's a little bit of a digression. Back to our example here. Nothing changed on her report except the passage of time, but her score dropped because the general public's dropped, and the algorithm was changed to reflect that. Okay? In the next part of the gray area, everything that I'm teaching you today is true today, but that doesn't necessarily mean it's going to be true tomorrow. Okay? Things change, laws change, regulations change, overlays change, and I put up 3 examples up here of big changes in the industry that have happened this year. There was one very recently here I want to talk about just a little bit more because it generated a lot of publicity, and a lot of you have probably heard about it. But Fair Isaac a couple Fridays ago put out a press release saying that their new FICO 9 was going to have 2 major changes in it. Number one, the impact of medical collections, whether paid or unpaid, was going to be lessened. Okay, so it's coded as a medical collection. It's not going to impact the score as much. And number 2, they were going to disavow paid collections. So if a collection has 0 balance, they were going to completely remove it from the scoring algorithm for this particular new model that's going to be available for purchase in the fall. And that was just, obviously, a lot of people, that was heralded. It made all the financial news stories that day, and a lot of buzz on social media. And it was great publicity for Fair Isaac. And to their credit, at least they have created a model now that is available that's perhaps a little bit more consumer friendly. But even with that, there's gray area within that. That's really not going to change the industry for a very, very long time. Number one, banks and mortgage lenders and anybody that use credit, just because Fair Isaac says, hey, we're not going to consider these predictive in this scoring model, Fair Isaac sells 23 different models, and they've been using those as predictive qualities for decades. So just because Fair Isaac decides for this it's not going to be, doesn't mean the banks aren't going to, and they're still going to be able to purchase the other scoring mechanisms that completely still factor those in. Okay? Another big part of it is, for mortgage in particular, you have certain scores that Freddie and Fannie and FHA and Ginnie have said that they approve for risk purposes for each credit reporting agency. There's a reason that whether you're pulling from Choice, Choice Plus, or from Profactual Data, or for First American Credco, or for any of them, you typically see TransUnion scored using Fair Isaac Classic 04. You typically see Experian being coded with Fair Isaac V2, and Equifax with FICO Beacon FACTA Enhanced. Those are the scoring mechanisms that are approved right now. FICO 7 came out in 2008, and it was the next generation beyond what's currently being used. They've been trying to get those scores to be used, to risk approve those scores from 2008 since 2008, and it has not been done yet. With the introduction of this new scoring mechanism, they're going to be 3 generations behind. So it's most likely going to be a bare minimum of 6 years before you could have any loan that's backed by those government organizations go through. It's not going to be an immediate change. And then lastly, for this particular issue, with the Fair Isaac change, they don't change the data. They don't control the data. That's controlled by the credit reporting agencies. And so in order for a paid collection to not be factored into the scoring mechanism, it would have to be coded as a collection account. But I'm sure everybody on here has seen it one time or another where you'll have Midland collection that codes it as a revolving account that's 90 days late. Well, whether it's paid or unpaid, if it's coded as a revolving, even though it's a collection, it's still going to be factored in the score like it's a 90-day past due revolving account. So it's not just a matter of them saying, hey, we're going to do this. It's a matter of the data at the credit reporting agencies has to be accurate and correct in order for this to make any sense for FISA, for it to even work with Fair Isaac. And that is something, especially with third-party collections, that we see virtually none of them are properly. And they've been revamping. They've been doing a lot of other things. They've been trying to bear down on them a little bit more because of how inaccurate this information is. I mean, you've got very well-respected consumer protection groups, saying that 90+% of trade lines are inaccurate, and we see that washed out very often, that there are massive inaccuracies in there. And so that also calls into question, not only with this Fair Isaac system, but with all of them, how can it work properly if the coding isn't always working right? And that's something we focus on a lot. Another thing with the CFPB that's a huge change this year, they're actually relaying complaints directly to the credit reporting agencies, which could facilitate faster change. In the past, the FTC did not do direct disputes with the credit reporting agencies. They did trends. They would do quarterly, we received 5,000 complaints on this and 7,000 complaints on this, and present a report to us at Experian. We had to respond to the report, but not to the individual complaints. That's a very huge change in how they're going to have to deal with that, with the CFPB taking those complaints directly. Okay? And then lastly, the stout versus free score was another one that this was a verdict, obviously, in an appeal that essentially made anybody that offers any type of credit advice, whether you're a credit reporting agency, if you're freecreditreport.com, freecreditscore.com, made them have to start complying with the Credit Repair Organizations Act, CROA, which requires that all services be rendered before they're paid. Now, that doesn't directly impact you, but it's certainly a huge change on the credit reporting agency, which could indirectly impact you, and it was extremely surprising. No legal experts expected that particular case to go that way, and it's just an example of that gray area where things can change in an instant when no one expects them sometimes. So again, recapping, with the risk and with gray area, understanding those two concepts will really give you a great filter on trying to get out a lot of those misconceptions. Now, with that said, we're going to move on to the next slide, and we're going to go over some of those misconceptions in a little bit more depth. All right, so the credit score itself, I already mentioned that it is an algorithm within an algorithm. And what I mean by that is that when you look at a mortgage report, you see a line on top that shows you the credit scoring model they use, the credit reporting agency, the social of your borrower, and then the credit score. And then there's 4 codes below that. Those codes are actually required by federal law. What they are is that every scoring algorithm, whether it's Fair Isaac or Vantage or whoever, has anywhere between 35 and 50, Vantage has quite a bit more than that, but usually 35 to 50 scorable codes. Those codes are what make up the overall credit scoring algorithm, okay? Each one of those little codes has its own equation for it that goes up and down depending, and more impactful, less impactful, depending on the behavior of that consumer. And then side to side, it can impact the other codes affiliated with it and make them more impactful as well. Obviously, it's a complex algorithm, but it is understandable. Each of those things, it makes sense that having a higher balance limit ratio might make a collection hurt you worse than if you had a lower balance limit ratio, because it's not only increasing your debt, but are you overextended? That's one of the risks that they might have seen. So those all impact each other. They have to also tell you what those codes are in order. Federal law requires they disclose to you the top 4 that are impacting the score in order of how much they're impacting. So if the number 1 is 10, proportion of balance to limit ratios, then that overall proportion of balance limit ratios is the number 1 thing that's forcing the score to be lower. Okay? Going into the different ranges for different models. Sometimes one question I get all the time is, why did this consumer come to me and tell me they had a 720 and I pulled it and they were a 610? Well, that has to do with the different ranges and the different models of score. I mentioned Vantage and Fair Isaac. Like Fair Isaac sells 22 and or 23 now, about to be 24 different scoring models. Vantage has 3 or 4 different scoring models. Equifax has their own internal called Beacon. It doesn't get used very often for mortgages, but it's very, very popular in the automobile industry. Equifax has Empirica and TransRisk. Experian has Plus Score. The 3 big credit reporting agencies are actually the owners of Vantage Score. I mean, you've got this complex web of all these different scoring mechanisms, and then within each of those, they can be tweaked for the industry you're in. So for mortgage, you might have a higher emphasis, both positive and negative, on the payment history for their real estate style accounts. Conversely, for an automobile dealership, they might have less emphasis on their mortgage history than they do on their automobile payment history. And it's like that for every industry. And then it can even get more complicated than that. You can have each bank have a scoring mechanism that's for themselves. So if I'm Wells Fargo, I have my own internal risk team. So I can buy a real estate enhanced FICO V2 to score, but then also I can say, you know what, within that, I want loyalty to my bank. So I can have Wells Fargo accounts where the payment history is weighted more heavily, if it's one of my banks, one of my affiliates, where the payment history on those accounts is weighted like it's an industry specific. So maybe on the same day this person with the credit report goes to Chase, and they have a late payment in the past on a Wells Fargo auto account. They apply for a mortgage at Chase, their score is going to be higher than it is at Wells Fargo, even if it's the exact same model on the exact same day with the exact same report, because that emphasis was put on that late payment history from Wells Fargo. Now, it might only be a couple points, but it's still going to be a difference. The range is also important when we're talking about these different models. Empirica, TransUnion's internal model, goes on a range of 200 to 900. Most Fair Isaac models are based on either 300 or 350 up to a maximum of 850. But even that's not always the case. Sometimes they truncate at the top and bottom, and they go from 375 to 423. That's a pretty common one you'll see nowadays because they've tried to make it less complicated for consumers to understand where they're at. Another one that's out there, Vantage, 500 to 999, where 500 to 599 is an F, and 600 to 699 is a D, et cetera, et cetera. So if somebody comes in, that's the example you see most commonly. They came in at a 720 on a Vantage score that they purchased online as a consumer score. Well, that's C minus. C minus on a Fair Isaac translates somewhere between 590 and 610. So yeah, they did have a 720, but in Fair Isaac, that's not what it comes out to. Okay. So I kind of already answered that. How many scores do you have at any point in time? You know, you talk to a fairly savvy consumer, and they might say 3. More likely, they might say 1. The answer is thousands. They have thousands of different scores from different banks, from different industries, and different models. And they're not always very comparable. I like to tell this story a little bit. I was talking to a lady that came to us, and her English was not very good. And her initial scores were in the 540s, and she had a lot of errors from a divorce and some medical collections. Nonetheless, we knew we'd done very well for her, and she went to a bank and pulled a score and came back with a score of 16. Well, and she called screaming, and again, there was a little bit of a language barrier, and finally I deduced that they were using, you know, first of all, I'm like, well, 16 is impossible. Then I realized, no, they're using a national risk model, and what that is a range of 1 to 1,000, or 999, that predicts how many people out of 1,000 with this profile would default in the next 12 months. So if you're 16 out of 1,000, that's a great score. But all she saw was she had dropped from 500 something to 16. So it can make it very, very confusing for consumer dialogue at times, certainly. This last one is there's a little bit of just kind of trivia to know. How many people at any point in time on a standard Fair Isaac model, 350 to 850, how many have those scores? How many have a 350? How many have an 850? The most common response that I get is 1%, or, you know, a very small number. The actual answer is even smaller than you probably think. It's 1. It's a terminating algorithm. So theoretically, at any point in time, they're trying to do a bell curve, and that has to have a termination point. So in theory, at any point in time, there should be 1 person in the U.S. with an 850 and 1 with a 350. Now, Obviously, it doesn't necessarily, they're not sampling all 250 million Americans with credit reports, but that's the way theoretically, based on their math, that it should work out. And probably there's, 500 or 600, maybe more people sitting at 849, and that circle in and out of 850 to 849 as the reports update. And the credit reports do update every 12 hours. The credit reporting agencies are receiving data from the Oscar, from their data tapes, on a regular basis every single day, and they're feeding it into the system, and that system is batching it and then dumping it into the system every 12 hours. So the whole credit report, your score can change dramatically every 12 hours based on who's reported to the credit reporting agency within the previous 12 hours, or what updates they've gotten on disputes, et cetera, et cetera. So you've got those two, and that's why earlier when I said the truncation, where it goes down, that's what they're doing, to try and make consumers less confused about how algorithms work. They're just cutting off everybody from 375 to 350 and giving them all 375, and everybody from 823 to 850 and giving them all an 823. So, and they put that as the range, because then that lessens, well, why don't I have the 850? Well, there's only one person in the country that has it. It makes them have to answer that question a little bit, and there you get the 1% at each side, okay? So hopefully we've got some good questions here. I know we're approaching that point where we get to them.
I got one for you.
Okay.
We talked a lot about disputes. It says, James, regarding the statement, consumer account in dispute, I've seen the credit score drop 20-plus points once we had the consumer remove the dispute, even when the dispute was 3 to 4 years old. The underwriter required that this be done because they state that this account was not being considered in the credit score evaluation. Pretty common.
Yep, absolutely.
I've seen it happen, and if it's not being considered in there, then why would it drop?
Okay,
within the 30 days?
There's two different things. Let me answer the part about the account not being considered. In any case, no matter what, even during that time frame, it's not that they're not considering the account. There are still parts of that account that are being considered. What they are not considering are the balance history and payment history. Now, obviously, those are two huge parts of the scoring algorithm, so that's why you do get that. When those are suppressed on a negative account, that's why you do get an artificial increase. I would have to see the report to tell you for certain. I mean, obviously, when you're looking at a mortgage report, you don't have the full story. I know there's, again, a common misconception out there that somehow mortgage reports are better, but mortgage reports, you have a bureau, Experian, FS, and TransUnion aren't bureaus. You have bureau like Kroll Factual Data that's picking out what data they're going to show you on that report. It's not full disclosure. So a lot of times to fully answer these kinds of questions, what we have to do is go back and look at the consumer report and see what changed there. Did a date change? Removing the dispute code in and of itself, as long as, again, it's not during that 30-day window, does not impact the score. It's not factored in. There's nowhere to put it in the algorithm. So there's one of two things. One, the creditor that was removed on changed something else about that account so that when it reappeared, it wasn't just in there. I will tell you, collection companies in particular, I don't know if this is a collection or not that you're referring to, but collection companies do have a trigger alert system where when they have a collection on somebody and something changes, like they try to rapid rescore and remove the dispute code or something like that, where they're alerted by it and they have the ability to go back in and then manipulate that through Oscar. So they could have very well gone in and changed the original date of delinquency or something else that would cause it to plummet based on a trigger alert. Yeah, or coded it wrong, absolutely. Gone and changed it from coded as a collection to something else. And the reason they do that, obviously, they want to get paid, and they know that if they impact the consumer's score more heavily, then they're more likely to get paid. And they figured out a long time ago that they can do that with the mortgage accounts and do those trigger alerts and make it where it's absolutely imperative that they get paid right away. They have to take less settlement. There's a lot of incentive for them to do that. There is another one. This is less common, but it does happen. Everybody has had an app crash on their phone. Everyone's had a computer go down and they couldn't explain why, and it came right back up. Every computer system has what's referred to in database, and we had to deal with this all the time, as you can imagine, in compliance. We had ghosts in the machine. Things happen that shouldn't, that it's not coded that way, but they do. And I have seen it, rarely, but on occasion, where the former dispute code didn't untrigger itself. It usually happens with human error, but it can happen with ghost in the machine errors too, where even though it's showing up as what should be an XC code, all of those statements of continued dispute are called XC codes within the Fair Isaac system. The initial investigation is an XB code. XB is the only one that factors in the score. But when there's a ghost in the machine or a human error, occasionally the flag that comes up with the XB coding can remain afterwards. It's very rare, but we have seen it happen. So, I mean, again, without seeing the report, I can't tell you for certain, but there's a few different options of why that happens that way. Okay?
Excellent. Diane asked, it seems like the scores frequently come in just 1 point below where the price break is for LTV score add-ons to price. Is this deliberate?
Yes, because those are thresholds within the system. Fair Isaac has its own set of thresholds, and they have their own verbiage for them. Anything below a 580 is considered very poor. Their words, not mine. Anything from 580 to 619 is considered poor. When you get to 620, you cross a threshold where you have fair credit, and that goes all the way up to 679. When you get to 680, you're considered to have good credit, all the way up to 719. At 720, you have great credit, all the way up to 749. Anything 750 plus is perfect. There's nowhere you're going to find any major price differential between a 750 and an 800 or an 810 and a 760. They just don't exist.
Excellent. I've already answered this one on.
Steve, I'm going to pop in here and go ahead and ask James, just in the interest of continuity here. There's been a lot of questions talking about date of last activity and original date of delinquency. And James, I know you've talked a lot about this, especially with the coding element and what it does score-wise to our borrowers. Can you talk a little bit about how, as loan officers, we can resolve that?
Absolutely. Resolving it from a mortgage report is going to be pretty difficult, and let me explain a couple things on that. For date of last activity is something that I'm pretty sure we've got experienced mortgage professionals on here. Pretty much everybody at some point has seen a mortgage report, and they saw a collection account get paid, and the only thing that changed was the date of last activity on that mortgage report, and the score dropped, and there was just nothing else you could see. And I know this is a hard thing to wrap your head around, but date of last activity doesn't have a clear definition. It's not a Metro 2 termination. Metro 2 is what everything has to be coded for Metro 2 to work with FICO, to work with the Oscar, to work with Experian. Date of last activity is just a term that happens at the bureaus. It's not even clearly defined. It could be the last time payment was made. It could be original date of delinquency. It could be the last time a status was changed. It could be the last time that it was reported to a credit reporting agency. There's no clear definition. With that, you can't put parameters on it. Without parameters, you can't express it mathematically. If you can't express it mathematically, it is not in a credit score. And I know that's a hard concept. The date of last activity actually is not factored into credit scores. Now, there are a lot of dates that are, and I think that's where a lot of the misconception comes from. The most important, far and away, being original date of delinquency. It's the most litigated terminology in credit reporting. It's been sued on in every state and every federal court, and it is very clearly defined, and it is also broken by creditors and subscribers on a regular basis. And quite frankly, the credit reporting agencies just don't, not that I guess that they don't have it, but they don't spend the resources to properly police. If you're a subscriber to a credit reporting agency, in any given year, the odds of you being audited are less than 2%. Half of the 2% they audit are typically previous offenders. So if a company's been audited in the past and found to be having misdoings, then there's a good chance they're going to be audited, but for just Chase, it's never been audited, odds of them getting audited by the credit reporting agency is very low. And what that means is the risk versus the reward for reporting inaccurate information that might allow you to get paid better or might allow you to charge more interest is the risk, the reward outweighs the risk in a lot of cases. And so you see ODD violated all the time. And first of all, let me define it. Original date of delinquency is defined as the first missed payment that leads to the most negative status of an account without becoming current again. So if you go 30 days delinquent in August of, or let's say in September of 2007, and you never make another payment on this $5,000 credit card, and here we are sitting in August of 2014, whether you paid it or not, that account is going to get deleted from your credit report next month. Okay? Because that first 30-day payment is where the 7-year federal statute started to run for that negative information to appear on your report. Now, collection companies, huge misconceptions about their reporting. What does their open date do? Where's their original date of delinquency? The answer is all of that goes back to the original date of delinquency with the original creditor. That's what federal law requires. So I don't care if here we are, this $5,000 Chase account with an original date of delinquency in August of 2007. I don't care if NCO collection buys it today. They get to report it until September. They've got less than a week that they can legally report this on the credit reporting agencies. Now, obviously, as I talk about the lack of oversight, that happens every single day. We see accounts 20 years old sometimes show up on a credit report. It's completely illegal, but it happens all the time. Some of the more common misconceptions that we see also, or I should say errors that we see with that as well, multiple reporting. So maybe NCO had bought that debt in 2010 and they sold it to West Asset in 2012. And then last year it got sold again to CBO. And we look at it and we see all three of these reporting. That's absolutely illegal at the federal level. You're only allowed to have one third-party collection reporting for any original debt. If the original creditor chooses to still report, they're not required to under law, but if they choose to, they have to show a zero balance. You can't double report the debt. Another one we see broken all the time, obviously, the original creditor doing that. So there's all of those are involved with ODD litigation that have been, again, fully resolved. But even though they're resolved, because the credit reporting agencies, there is another reason as well, they have a right to reinvestigation. If you pulled your report today and you had 10 bankruptcies that weren't yours sitting on there, and you sued them without giving them the right to investigate it, you would lose. They have a right to reinvestigation. You have to notify them of an inaccuracy. But what that means is that's why they don't spend as much on oversight. Well, one of the reasons they don't spend as much on the oversight, because they don't really have to. All they're doing is storing it. A lot of the problem with this is with the subscriber, and that's kind of, to Eric's question, that's where kind of the problem is. Your mortgage report doesn't tell you what the ODD is. In 99% of cases, it's on the consumer credit report. And even if it did, you're going to have to wait the statutory time adjusting the credit reporting agencies, and you're probably going to have to deal with the creditors. As you can imagine, it's time-consuming and it's difficult. That's what we do. So obviously, we're an option for you on that. Let's see. I guess that's I know we're at the end of time here. Do we have some more time for questions, though, Erik?
Yeah, we got a little bit more time. Tell you what, folks, while you guys are posting your questions, and by the way, forgive me for not introducing our other panelist. One of James's top team executives, Director of Business Development, is Steve Emerson, who's also on the line with you guys. You heard Steve chiming in periodically throughout here. As these guys are posting additional questions, there's a couple of things that I wanted to make sure you guys are aware of, and Steve, you and I talked about this as well. Obviously, you guys can see that CRE Credit Services, they are a credit repair service. They do work on behalf of mortgage companies to help work with your clients who fall in bucket 2 and bucket 3 to clean up the credit issues that are preventing them from getting a loan. And they do it from a very different perspective than maybe a lot of the credit reporting agencies that you guys have worked with in the past. They do it by using legitimate ethical practices of disputing the errors in coding that are so often and most commonly the issues that are causing those FICO scores to be poorly representative of that buyer's actual credit risk. So if you're wanting to operate at an ethical level, if you're wanting to operate by getting, not necessarily going in and just, boilerplate like a lot of the old credit reporting agencies or repair associations that were out there, they would go in and they would do credit repair by just a blanket dispute of anything derogatory on the report, and they would try and clear off as many of those things, whether they were legitimately reported or not. What these guys do at CRE is they work with the consumer and with the actual details of the report, similar to what James has shared with you guys, about what exactly it is that is causing that miscoding of an accurately reported derogatory to negatively impact the score a lot more than it probably should. They deal a lot with stuff like what James shared about the original date of delinquency and making sure that those issues are being reported correctly on the Bureau, and therefore that the actual score being driven is an accurate representation of that borrower's credit risk. So what Steve and his team have put together here is they've put together an option to work with CRE as an affiliate, and Steve, I'll let you share a little bit more about the affiliate program here in just a second. But what they've offered to you is if any of you would like to consider how to work with CRE as a support resource to you as an originator in helping you work with your customers to get them from you know, a 580 to a 640 so that they could get into a good home because they are a good borrower who has a good willingness to repay their loan, but their score is irreflective or erroneously causing them or blocking their ability to buy a home. Steve and his team do an awesome job of working with you guys, and like I said, they do have a great affiliate program that allows you to work hand in hand with a dedicated team of individuals and representatives. If you'd like to take advantage of that, Steve, why don't you share a few words about what else they get with the affiliate program, if you wouldn't mind.
Sure. One of the main things that you're going to see differently with us is communication. I think that's one of the probably the biggest complaints I've heard about credit repair is that you refer them off and then you just never hear from them again. The biggest thing is we're going to keep you and your client updated about every month and a half. It's kind of redundant if you do it any more than that. The reporting agencies have rights too. Anyway, and we're going to keep you updated all on the way, update your client, and also that you can update your realtor and know when to pull the trigger. So basically it's communication.
Definitely. And like I said, if you guys would like to take advantage of one of those consultation appointments to find out more about becoming an affiliate with CRE Credit Services, probably the best way to take this, and I know, Steve, you've got a limited amount of availability for this, so these are going to be filled on a first-come, first-served basis, but if you'd like to talk with CRE about becoming an affiliate, participating in that program, and what it would look like and how much it would help you with improving your borrower's credit scores, you're welcome to take advantage of that. The easiest and fastest way to do that is to go ahead and post in the Q&A section that you would like one of those free affiliate consultations or credit affiliate consultations with CRE and their team. Go ahead and post the best phone number and email address directly in the Q&A platform right now. Let Steve and his team know that you'd like to talk to them about becoming an affiliate, and he and his team will set up a schedule, an appointment with you as fast as possible to make sure that you're getting that level of support. Otherwise, guys, let's go ahead and get back to Q&A here for just a little bit longer. In fact, for those of you who do have the luxury of being able to stay on with us a little bit longer, we're probably going to run a little bit long today because I know this is a wealth of information. I got to tell you that this is probably one of the most engaging levels of conversation I've seen in the chat window in this forum in a long time. So there's a ton of questions in here. Let me read through a couple of these. James, first of all, when you looked at the Q&A log, did anything jump out at you as something that you'd like to address real quick?
Steve's been the one looking at it for me.
Well, there's one here regarding the FICO 9.
Okay.
Let me go ahead and read that, Eric.
Yeah, go ahead.
So, okay, will the other two scoring models follow suit, and how do we know if our credit agency is pulling Model 9? I think that's an easy one.
Yeah, absolutely. You can always see which score with your bureau. You can always see which score they're using for each credit reporting agency. They don't necessarily, in fact, typically they don't use the same scoring mechanism for each of the 3 credit reporting agencies. They've got a head beam counter in charge that said, well, we feel that this particular model is more representative of the data that TransUnion is going to provide us, and this model is more representative of the data that Equifax is going to provide us. And there are differing levels of data there, but you're always going to be able to see which model they use on typically the first page or two of the credit report. The FICO 9, obviously right now this is just conjecture, but I believe it's pretty educated conjecture, and I don't see it being used very much at all. I think the primary competitor that they're going after is Beacon in the auto industry. I can see dealerships being much more willing to not consider paid collections and to not consider medical as heavily, whereas the risk modelers for the banks, for mortgage lending in particular, but for any type of large signature loans or even for credit cards, they've seen those so much leading indicator information from those being present. They've seen them be predictive. So I don't see any change in the near future where any of the major lending institutions outside of perhaps auto are going to make that leap. So I mean, obviously time will tell, but that's what I predict.
There's another good one here.
Sure.
This is Raul. What is the weight of tax liens on the credit scores?
Sure. I'm actually going to take opportunity to talk about both tax liens and judgments. There are only 3 types of public records that will appear on a consumer credit report: bankruptcies, liens, and judgments. Liens in particular, tax liens are obviously the most common we see, but any lien can show up. You can have a mechanic's lien or a contractor's lien or a county lien or a franchise lien on the report as well. When they are unpaid, when they're not released, they are a very, very strong impact on the credit score. Obviously, beyond credit scoring, having unpaid tax liens is a death knell for most types of lending. However, with both judgments and liens, once they're released or satisfied respectively, the impact on the score is negligible, if at all. And the reason for that is most lenders, their risk departments, they don't necessarily see judgments or liens as somebody's willingness or capacity to repay their other debts. Those are different types of things. It's not borrowed money. It's not repayment history. You can get a judgment for near anything. I mean, if your dog goes number 2 on your neighbor's yard too often and he sues you, that judgment would show up, and he wins, that judgment would show up on your consumer credit report. So it's not necessarily about your willingness to repay your debt as they see late payments and judgments and other types of things as foreclosures,
right,
etc.
Awesome, awesome. Hey, guys, I'm going to jump in here real quick, Steve, while you search for the next question that you want to address. There's a couple of quick housekeeping things that I just want to cover right before we close, hit the top of the hour here. I just want to remind folks, if you are interested in finding out more about the training and development services offered by Maximum Acceleration and how we as a coaching and training team provide group coaching, one-on-one coaching, and virtual programming, you're welcome to check out our website. Go to mxlcoach.com. Of course, if you would like more information about working with our coaching team, getting direct guidance, support, and accountability on how to grow your business faster, we offer what we call a no-cost and obligation strategy session, just the simple and fastest way to identify what we can help you do as a growth curve is to experience coaching and what it can potentially do. Of course, there's no cost or obligation for that service. If you'd like to participate in a coaching strategy session, just again post in the Q&A that you'd like a coaching strategy session with the best phone number and email address for our team to catch hold of you. Secondly, NAM National is coming up in a little over 2 weeks, and if you would like more information from James Charlet and his team at CRE, make sure you come on out to the NAM National Conference. James is going to be one of the main panelists there at the event, and he's going to be going in a lot more depth. We also have a great opportunity to meet him and his team at the event live, so come on out to Las Vegas at the Luxor, September 13th through the 15th. Really one of the best investments you could possibly make. Your ticket's only $345. They've got a great room rate at the Luxor available. There are still a limited number of those discounted rooms available, and really, total investment probably $1,200 to $1,500, and get 2.5 days of some of the best training that you could possibly get in the industry. It's one of the best investments and one of the most accessible areas to get to for pretty much anybody in the country. So come on out. Last thing I want to remind all of you to do is we want to applaud you for taking time and initiative to join us for today's program. The last thing I would encourage you to do is take these ideas and do something with them. James has shared an amazing wealth of information, and I know he's going to be hanging around for a little bit longer here and taking a few more questions as we have time. Do something with the knowledge that you've gained today. Ideas without action are totally useless to you. So here's what I want you to do. Pick the one idea you found most valuable in today's program. Decide what you want to do. Secondly, decide what action you need to take as an individual to make that a part of your daily business going forward. Maybe the next action is sign up for one of those affiliate consultations with James and his team to find out more about how to work with CRE on an in-depth basis and how CRE can help you and your borrowers overcome the credit hurdles that are preventing them from getting a loan. Third is put an action date on it. Put a timeline, put a deadline on when you want to complete that action, and create a sense of urgency yourself that holds you accountable to following through on those ideas. And fourth, decide who is going to be your accountability partner that's going to help you make sure that you get these actions implemented. So with that being said, James, I'm going to kick back to where we could do some additional Q&A. I don't know what your time frame are. I know your knowledge and advice is highly sought after, and you know, anytime you can give us, we'd be happy and appreciative of your willingness to answer a few more questions here. I apologize, I just had to get that last little piece in there about before the top of the hour, but looks like we've still got a pretty good crew here. Steve, you got another question that
I'm ready to roll. Okay, the next one I buried off. Okay, the next one is, what are the options or recourses a consumer has when there are illegal drugs on their credit report?
Yeah, well, obviously, we would love for them to speak with us. They do have other options. They can, the ones that are effective typically require intervention by someone, whether it's us or another governmental agency. Certainly filing a complaint with the CFPB for anything. If they're going to go to the any governmental, they're going to have to say, have they already investigated it? So before anything else, they do have to notify a credit reporting agency of the error on their report. They've got to be able to identify the error, of course. And then if it's not resolved, which can, you know, as we all know, take 45 days or more with processing time and mail time and everything else. Sometimes it's faster, but they do have those rights for that amount of time. Once they get that response back, if it's not corrected properly, then they can go on to filing a complaint with the CFPB or their state attorney general. So there are avenues. There is recourse. You know, the one kind of, in my opinion, misconception out there is that it's easier, that there's not a lot of red tape. That's, you know, that's for consumers to do this on their own. You know, yes, a consumer can legally address the credit reporting agencies and go after them on their own and learn the laws. But, you know, I always think to myself, well, I also could remove my own appendix if I had enough lidocaine, but I'd prefer to let a professional do it. So, you know, unfortunately, a lot of times, and it's hard, especially when it's not the consumer's fault at all, when it's a fraud situation or a mixed file that's something that's created at the credit reporting agency level. I hate that they have to go spend their own hard-earned money to fix a problem they didn't create. But sometimes that's just, we all have to do that sometimes with things.
Okay. I'd like to elaborate on something here. Another James is interested in the affiliate program. What you can expect when you speak with me is I'll answer all your questions about our program itself, as well as what we do and how we do it. And furthermore, I like to go another level and introduce you to our entire team here. So you're going to understand what your clients are going to see, what you're going to see, basically a whole experience of the process from start to finish. And I'll explain everything to you, and I'll give you very realistic expectations, because we're going to have to live up to them. So you've got my email address. I've given you my personal cell phone. All you have to do is reach out or provide me with your information, and I'll reach out, and I truly look forward to it. I believe that's our last question. Okay. Are there any more questions? We'd be happy to answer them now.
Well, there's a few more that I think you guys might be able to sift through. Guys, I got to tell you that as a coach and as a business development and trainer of, you know, spending the last 14, 15 years doing this pretty much professionally, there's a specific reason that I asked James and his team to present in our webinar platform, and I've been very hesitant over the years to endorse any particular credit repair company, and part of the reason for that is that, you know, there's always a question of ethics and whether they're using the best business practices. I've also had a lot of clients, coaching clients. I mean, the whole idea of this, guys, is you don't make money on credit repair. You make money on doing loans. So why would you spend hundreds of hours as a loan officer trying to educate and coach your clients on how to deal with these really minute fine print detail stuff that's even very hard for many of us to even wrap our minds around? I mean, some of the stuff that James shared about the minor issues in coding, or the data, the original date of delinquency type stuff. I mean, I wouldn't have ever known how to resolve that. But at the end of the day, is it highest and best use of my time as an originator to babysit my clients who have some, you know, derogatory credit issues? Or am I better off to focus on the one or two who are ready to go right now and work with an alliance partner like CRE, who has that in-depth knowledge, who has that ability to very quickly and easily assess for a client where the coding errors are, that are really bashing their scores and fix it over time using ethical, legitimate, and legal methods to get the score to reflect what the borrower's real risk is, which is ultimately, as an originator, what we're trying to do is produce good, quality, serviceable loans that will perform. So I can't recommend any more than, in fact, everybody on this call. I think all of you should sign up for the affiliate consultation, because as a loan officer, remember, you don't make money unless you're closing loans. These guys are here to help support you.
Erik,
part of the reason I love these guys. Yeah, go ahead, James. Or go ahead, Stephen.
I missed a question, and I think it's an excellent one. I want to spearhead it head on. Someone asked, do we collect any money up front? And I want to answer that. So the way that we operate, certainly we operate under Texas law, which is one of the most stringent laws for credit repair organizations from an acceptance of money standpoint. We cannot collect money after 180 days, so 6 months. Our program, think about this, guys. It's the easiest way I can tell you. Our program, we sign up NFL players and we sign up first-time home buyers. There's a significant difference in the pendulum of income there. So we will treat them as such. There is no one-size-fits-all on how we sign somebody up. Some people can, and by the way, it is illegal to accept money up front without doing the work first. We always do the work first, then we bill. Do the work first, then we bill. How much we bill depends on how much that client can really afford. And we have a set price list. I will explain all that to you when we talk. I'm very transparent. There's nothing to hide. But we are very stringent in operating under Texas law, which is amongst the most stringent in the union. And we will do it. We will fit it in to how your client can afford it, because everybody's different. Every report's different. Every income's different. So I thought that was a great question, and we always do the work before we charge anything. And this is also not trying to go on and on and on forever. It's a 6-month commitment.
Yeah, so in other words, you do a complete assessment up front, you determine what can be fixed, you give them an estimate of what it would cost to fix it, and then they make the decision on how to pursue it, and you go from there.
Absolutely. One other thing on that, Erik, we have an ironclad money-back guarantee, and we don't like to give people's money back. So there's a couple things on that. If we don't think that we can help them based upon our own experience of, I'd say, about 15,000 customers, we will not sign them up. And we've got a reputation with the mortgage community as well. Ultimately, you're our clients, and you send your clients to us. So we will do the right thing on the front end, because we're going to have to live up to it on the back.
Yeah, definitely. Well, guys, I mean, we all know that the game of credit score is a game that collection agencies and creditors play to try and get their money, whether legitimately earned or not. And so there's always a fine balance there. But when you have a client or a borrower who is prevented from getting a home because of erroneous reporting, because of miscoded or misreported collections that are a violation of law, it's a very complicated process to resolve. I don't know if you've ever tried to resolve derogatories on your own. I know my personal experiences, I've had a number of accounts that were, many of you know my history, having multiple sclerosis and had serious medical issues in 08 and 09 that caused serious financial issues for my family and I. And there were a number of those issues, legitimate derogatories, but there are also a lot of those legitimate derogatories that were misreported, grossly misreported, and I tried to fix it on my own. I mean, I've been doing mortgages since 1996. I consider myself to have a pretty in-depth knowledge of FACTA, Fair Credit Reporting Act, and the other credit reporting laws at work, and I found it to be incredibly difficult to navigate through the process of trying to dispute with the bureaus directly. I mean, my personal opinion of it was when I was trying to work with bureaus directly, it was a guilty until I could prove myself innocent type process, which is not the way it's intended to be. But every time I would talk to the customer service people at the credit bureaus, I got nowhere. And it wasn't until I started to work with CRE and some of the folks that used their level of knowledge and their level of approach to how to resolve it that I got anywhere. You know, as an originator, you know, certainly encourage your clients to file complaints and disputes through CFPB, but you know, the element of it is you need the asset and resource of somebody who's an expert in the field who can look at the credit report, determine is it a miscoding error that's really dogging the score, or is it a original date of delinquency issue that is making it report as if it were a recent collection as opposed to something that happened 5, 6, 7, 8, 9 years ago. You know, these guys are experts at that. Leverage them. You know, focus your time, energy, and effort as an originator on the stuff that you can do that's going to be doable and closable loans now, and let these guys work with you to handle everything else. They will keep on top of you, they will keep you informed, and they will keep you moving down the path towards higher and more productive origination capabilities. And they'll bring your deals back to you, they'll bring your buyers back to you, and they continue to enforce and edify you throughout the process. So with that being said, guys, there's a few more opportunities here. If you are interested in affiliate consultation, again, the best and easiest way to do that is to go ahead and post that here in the Q&A platform. The best phone number and email address for Steve and his team to get a hold of you and schedule that affiliate consultation. Go ahead and post that in the Q&A section of the webinar right now. Just in the interest of time, if there are any additional questions, feel free to go ahead and post them in the Q&A platform at this time. And then just one other final comment that I wanted to share with all of you as we kind of get to wrapping this up real quick here. You know, I know Steve and his team and James are very dedicated to helping you grow, as are my team at Maximum Acceleration. You know, our only goal is getting you from where you are to where you want to be as an originator as fast as humanly possible. So if you're interested or curious about what coaching looks like or the value that it can create in helping you accelerate your business growth, the best way we've found to help you understand the value of it is to actually experience coaching. So if you'd like to talk to us about the coaching services, we offer what we call a no-cost, no-obligation strategy session. You'll get some direct coaching and guidance on one particular issue or challenge or opportunity for growth that you see in your business. Along the way, we'll talk a little bit about some of the P's and Q's of the coaching program and what the commitments are on both sides. If you're interested in taking advantage of one of those coaching strategy sessions, also please go ahead and post that in the Q&A section of the webinar platform at this time. Otherwise, any questions for myself or any questions for James and his team, feel free to go ahead and post those questions in the platform right now, and we'll be moving through and wrapping up here in not too distant future.
I did find a few more here that I missed. I apologize.
Okay.
Okay, ready? Are child support collections supposed to be removed after 7 years?
Yes. Everything that is a trade line that's not a public record, and child support is not considered a public record for consumer credit purposes, is supposed to be removed 7 years. And I will tell you also, with child support, there's another part there as well. It's in the best interest of the child, in most cases, for the obligatory parent to have good credit. They only post that as a negative item to try and make sure that the child gets taken care of and paid for. Once the obligatory parent is on a payment plan or on a garnishment or is current, usually by contacting, we have contacts within most of the Office of the Attorney General's nationwide, and we contact them, and they will, as long as they're current, they will report it as a positive trade line. So they'll take they'll turn it from looking like a collection into just looking like an obligation with no negative payment history. Again, they just want the money for the kid. They don't want to negatively impact the credit of the parent if the parent is taking care of the child. And that's something we're very, very successful at.
Here's another one.
Awesome.
Okay, all right, another one.
All right, I'm sorry I missed this before, guys. Impact of inquiries. Mortgage-related count is 1 within 30 days or 45 days, correct? So mortgage-related inquiries.
Oh, yeah, absolutely. In fact, this is something I love to talk about because it kind of illustrates how the misinformation gets out there sometimes. A lot of times misinformation is not based on someone trying to deliberately obfuscate information. It's just a matter of it was accurate when they put it up, and now time has passed, and the web doesn't necessarily let go of it. I mean, you can still go to Space Jam's opening website when the movie came out. It's still there. And so what we see is you see misinformation. So prior to 2004, within the scoring algorithms, any mortgage inquiries within a 15-day time frame counted as 1. But then that changed. In 2004, it became 30 days for both mortgage and auto. So that's a huge change. Add another industry and double the amount of time. That happened in 2004. Now again, last year, Fair Isaac went and changed all their algorithms to meet what consumer demand is. And that's the reality is it's longer closing, longer time frames. And what they did was pretty cool. First of all, they added student loans so that you're not punishing people for shopping for student loans. Now there's another industry. And at the same time, they added a 15-day rolling window to the end of that 30 days. So let me kind of explain with an example. So if you go and apply for a mortgage today, August 26th, and 30 days, or let's say 29 days goes by. So here we are on September 25th, and you apply for another mortgage, same permissible purpose, both for a mortgage, and then the 30 days passes. A new 15-day window will open at that point from the date from September 25th and go out 15 days. If you apply again for a mortgage within that 15 days, that will count with those others. So even though you had 3 over, let's say they did it again on October 1st, you had 3 within 40 days, they're still going to count as 1 for scoring purposes. Now they'll all be listed on the credit report, but they'll standardize to 1 for scoring. And then another 15-day window opens at that point as well. So it's October 1st, they apply again. If they apply again within 15 days of that, that'll standardize too. So essentially, if within 15, after the 30-day window, if they keep applying and searching, and they're still searching and applying every 15 days or less, those are all going to standardize for infinity down to just 1. Because it could take a longer time than in the past to shop for that. What that also means is that you might have had a borrower at a time come in and say, I don't want you to pull my credit, it's going to drop my score because this guy down the street already pulled it. That's not true. They're going to standardize to 1 as long as it's for the same permissible purpose for one of those 3 industries. Anytime you apply for a credit card is a hard inquiry regardless. You can't shop for rates on credit cards. Same thing with certain other things. But for auto, student loans, and mortgage, they'll standardize down to just 1. What that also means is if they go to a car dealership and they say, oh, yeah, they shotgun it up to 30, well, that's okay because it's still going to count as just 1 for scoring purposes. Now, 1 inquiry can really hurt your score, and come see me at the National Association of Mortgage Brokers. I'll tell you about that. A little bit more about how inquiries can impact your score that much. But nonetheless, it's never all of those inquiries standardized down to 1. They're probably just surprised by the amount of impact they had from that 1 inquiry.
Yeah, absolutely. Absolutely. Hey, Steve and James, one of our active coaching clients, Mr. Tony Cardinale from Boston area, is asked the question, if we're looking at a credit report with an account in collection, is it the event that the debt went into collection that is hurting the score, or is it the ongoing reporting of the open collection balance that's hurting the score?
It's the initial event. Actually, from there, even though they report it every single month, and we see that all the time where they go, well, look at this string of key derogatory, or look at this string of collection. Isn't that more heavily impacting the score? And the answer is no. In fact, it's still lessening. It is not a myth. It is true that over time, over the course of that 7 years, the impact of the negative information does decline. It decreases as time moves on. And there's a couple of big thresholds, 2 years being one of the big ones. And that measures from that original date of delinquency. Now, what you do see on occasion is where you'll see, 30, 60, 90, 120, 150, 180, charge off for 3 years, and then they throw in a little current in there and then start doing charge off again. Well, remember what I said about original date of delinquency, that it's, from the first missed payment where they didn't become current again. when they throw in that little current, there's a term for that. It's called re-aging, and they do it deliberately to lower the score. So if it's the string of delinquency isn't going to impact you, but a string of delinquency with 1 month current thrown in there, that can really negatively impact you.
Yeah. I mean, I guess it's you know, I mean, keep in mind these professional collection agencies, they know how to manipulate the scoring game as well. I mean, James, you and I have talked about this before about, you know, I mean, at the end of the day, educating consumers, the simplest explanation I've ever come up with is you know, guys, credit scoring is a game. You get positive points for what the banks consider to be responsible use of credit. You get negative points for activity that the banks consider to be irresponsible use of credit. You got to have enough positive points to offset any negative points, right? If you don't use credit at all, you get no points. So,
exactly.
But these
that scale. You got to put something positive on the side.
Right. And not only that.
Sorry, go ahead.
Go ahead. Oh, well, what I was going to say. We're having fun now.
Yeah.
I think the biggest thing about it is that these guys, I mean, the collection agencies, not James and Stephen, but the collection agencies are very good at manipulating the scoring models in their favor because they know the game. Unfortunate as it is, as illegal as it may be, they get the idea that if they want to get their collection account paid off, they need to do something that's going to prevent that consumer from getting something they want, like a car or a house, before they're going to get paid. And so that's why they do it. I mean, illegal as it is, but that's where James and Steve and his team come in to, you know, helping customers get that thing accurately reported so that the collection can be paid off without it really tanking the scores, that the creditor can get what they want, which is a reasonable settlement of the original balance of that account. Our borrower can get what they want, which is to move beyond it and get a home, right? That doesn't happen without the accuracy of the information being reported, however, and that's where these guys can be such a huge asset to you as an originator or a realtor in getting your borrower's issues cleaned up that are preventing them from getting a loan. And that's why we titled this program, what you really need to know about what is really causing your borrowers to miss out on loans. Anyway.
Hey, Eric, there is another excellent question regarding authorized users. My computer died over here, so I'm just going to have to go off memory, but it's basically with authorized user accounts and anything that's negative on that authorized user, once that's hitting your report, how willing are creditors to remove that?
It's a great question, and
it is.
First of all, with Experian, again, this is always in theory. It has to be coded right. But in theory, our system at Experian was much more sophisticated than Equifax or TransUnion. And with authorized user accounts, with any negative information, obviously you could interpret balance limit ratio as negative, but I'm talking about actual derogatory late payments, charge-off, et cetera. Experian purges those automatically because they recognize that the authorized user doesn't have a contractual obligation, so they'll leave it on there if it's beneficial to the consumer and remove it if it's not. That is not the case at Equifax and TransUnion. However, regardless of whether or not the creditor wants to take it off, in most cases, even with Equifax and TransUnion, if the consumer asks the credit reporting agency, says, "I've got no contractual obligation for this, don't want it on my report," most of the time the credit reporting agency will remove it without even, they'll notify the creditor that they've done it, but it would be a permanent removal at that point. And then there was one other one here too. Said, how are some companies able to get BK and repossessions, et cetera, off? And BK, obviously being a public record, is a little bit different. Let me talk about the other ones first. With anything, be a repossession or a foreclosure or a late payment, there's an obligation on the subscriber, on the creditor, to report it accurately, to not break the rights that the consumer has, be it Fair Credit Billing Act, Fair Credit Reporting Act, Fair Debt Collection Practices Act, et cetera, et cetera, et cetera. Those are consumer protection laws. And the reason that they come off is if one of those has been broken, if they're reporting an incorrect original date of delinquency, if they're re-aging it, if they're doing something illegal in an attempt to collect it, and they feel now that the risk that they took in doing that is outweighing the rewards, then they'll remove that. Nothing requires anything to be reported to a credit reporting agency. In fact, the Fair Credit Reporting Act is very, very specific that if a subscriber chooses to report information to a credit reporting agency, chooses, they don't have to, then that information must be 100% accurate, complete, and verifiable. Sometimes it's even a positive account. Give you an example. Discover Card does not like to report their limits because they feel like they get shopped, and they do. I mean, Citibank will come in and find all the Discover accounts that have an 80% balance limit ratio, and the consumers have a score north of 680, and offer those consumers a $20,000 Citibank account with 0% 12-month introductory APR, and say, you know, transfer that Discover balance over to us. Well, Discover doesn't want them to do that, so they choose not to report limits. And what that does is it causes the balance, the high balance, to also be the limit. In the absence of a limit, they'll use the highest balance. So let's say it's a $20,000 card, but they've never had more than $5,000 on it when they were on vacation. Well, that vacation was last week, and now it shows like they're 100% tapped out on account. They only tapped out at 25%. So then I go back to the Fair Credit Reporting Act and say it has to be 100% complete. And if it's not, you're not reporting the limit. That's not complete, and federal law requires that. So sometimes it's not even necessarily the negative account that's the biggest problem. Sometimes it's even a positive account. And then for a bankruptcy, obviously, a bankruptcy could be reported inaccurately. It's possible. It happens, particularly depending on the skill of the attorney involved, that a Chapter 13 can have very inaccurate information when it gets reported. That's rare, though. Removing a bankruptcy, what most people don't understand, if the person completed the bankruptcy, it's actually good for their credit score. They're less of a risk after the bankruptcy. So it's possible to remove bankruptcy, but it's usually not necessary. Usually what's really negatively impacting the score are the trade lines that are being reported inaccurately that were included in the bankruptcy. So you had a Capital One account, and it was current when you filed bankruptcy. So it should go right into a bankrupt status. Instead, they make it look like you went 30, 60, 90 charge-off and then bankrupt. Well, especially if those late payments are reporting after the file date of the bankruptcy, the impact of the score is enormous. Detrimental. So it's fixing those trade lines to be reported accurately and legally that's going to increase the score.
Exactly. Exactly. Well, guys, there's a million great questions in here, and I know we could go forever on this if we wanted to. I know, and I do, by the way, a great big thank you to Steve, James, and the whole team at CRE to bringing this quality of information. Definitely got to get you guys on to a more in-depth program and look at that certification program, James, that we were talking about a couple of weeks ago. You know, you guys are welcome to hang out. I'm going to go ahead and shut down the recording at this point. You know,
yeah, and actually we've got a couple meetings we got to get into as well.
Okay, great. So with that being said, guys, if you need to hop off, thank you so much for the time you've given us. A great program today, just a huge wealth of information, folks, that our audience has had the opportunity to learn from you today. Thank you once again for being willing to share that information and work with these originators and realtors on board today.